Good morning and welcome to Cornell Cooperative Extension's monthly Consumer Issues Program. I'm Kenneth McLaurin, the Financial Management Educator here at CCE Tompkins. Today we have with us Michael Danaher, the New York State Assistant Attorney General, and the topic he will be discussing today are the ins and outs of insurance. Michael?
Thank you, Kenneth. Welcome, everyone. Those of you out in television land watching us. As Kenneth mentioned, we're going to talk about the ins and outs of insurance. And we're repeatedly challenging people to be good consumers. And that involves not only exercising consumer rights, but also to accept the consumer responsibilities to understand what's going on, to understand transactions, to understand what you're getting yourself involved in. And that's no more true than when we were talking about issues related to insurance products. Most of us are not experts when it comes to insurance. It's one of those unique things that we actually need it before we would want it. When you think about it with consumer products, they're usually things that we want before we need them. Be like cars or houses or computers or things like that. When we go out and buy things, it's usually we buy them because we want them. And then it may prove out that we need it, but we want those. It's a little bit different when it comes to with insurance products. Because think about it. If we are going to get a new TV or something, we want that TV. In a lot of instances, the old TV is just fine, but we need the big TV. Now they're starting to be curved, and they're really bright, crisp picture. We really want that, and we go out and get it. And once we have it, we have something there to hold on to. It could be the television or our new computer or anything else that we purchase. So we actually have something that we can grab onto, and we can look at it and say, wow, look at this great TV that I just received for the money that I paid. Insurance is a whole different ballgame. None of us really wants to have to spend the money for this thing that we really can't get a hold of and grasp. I can't say that even when we have it, that we really like it like we would like a consumer product. But when you sit back and think about it, we are often very glad that we have it when we actually do need it. I just have an example from not this past winter, thank goodness, but the winter before, where the water line going into my house froze, or actually it was underneath our foundation froze. And we ended up having to spend thousands of dollars to have a new water line installed. And everyone can remember how horrible a winter it was the winter before last. But we approached our insurance company, and actually the insurance company paid the claim because it was a frozen pipe that was located within the four walls of our house. It was actually under the foundation, but within the perimeter of the four walls of the house, and it was a covered claim. And I can't say that every 6 months or a year when I pay my insurance that I'm really happy about writing that check, but I was very happy that I had written that check when we ended up getting reimbursed thousands of dollars for fixing something in the house. So again, it's not something that we really can grab a hold of, that we can look at, we can see every day, but it is an important factor that we have to take into account. Because it's not something that we can go to the store and look at it and choose between this one or that one, we may not spend enough time evaluating what our needs are and determining what is best for us, which is exactly what we need to do if we want to be a good consumer. Is we have to sit down, we have to evaluate, we have to make a decision, and make the best decision that is personal to us. Insurance, what is it? Well, insurance, people have to understand, is a product that's designed to protect us in the event of a financial loss. Think about it. The root of insurance is insure. And I had the opportunity to look up what the definition was for insure, which is to make certain, especially by taking necessary measures and precautions. So it is to protect us in the event of a calamity, and we'll get more into what it's not in a couple of minutes. But insurance is really just a contract. It's a contract whereby one party undertakes to indemnify or guarantee or protect financially against a loss that specify to a specific contingency or peril. That may sound a lot of gibberish there, but really it's a party's undertaking to protect us financially should we sustain a loss based on some particular event. And again, it's governed by the contract, so it's whatever the insurance company has agreed to protect us from. And we have to really understand as consumers that insurance is for protection. It's not necessarily an investment. Some insurance people in years past have been out there trying to sell us things as, quote unquote, as a good investment. But you have to understand what you are going for when you're going to purchase insurance. And that is to purchase protection, not to make a particular investment. There were, back in the day, life insurance sellers. And I'll talk a little bit more about life insurance in a few minutes. But life insurance sellers were selling these things called vanishing premium life insurance policies, which meant, in essence, that the premium would vanish over a period of time. And a lot of times they were being sold as, hey, look at it, if you invest in this particular insurance product, you only have to pay for a certain period of time, then the premium vanishes, and on top of that, the value of the policy increases over a period of time. So you'll be able to stop paying, but this policy gets bigger and bigger, and then when the event happens, in this case a death happens, that you'll get paid all this money. And a lot of people were sold that. A lot of people bought it based on the fact is, hey, it's really kind of an investment. I'll put in some money now, and it's going to be so much greater in the future. That isn't necessarily the case. I think what people need to do is really focus on what are you getting this insurance product for, and buy it for that reason, not for some reason that is not related to protecting yourself. And there's many, many, many different types of insurance products out there. You can always buy insurance for something if you need to be protected. One of the big ones that we all think about, actually mandatory that we have, is our auto insurance. And although someone may read this and get confused and think that this is just too complicated and their eyes roll up in their back of their heads and I don't understand that, just sell me something and I'll buy it. That's not a good way to handle it. The auto insurance protects us for loss of property and injury to ourselves and to others as a result of operating the motor vehicle. Again, every insurance company, every automobile we're required to have insurance on. We're required to have minimum of insurance. They call it, they say that it's certain limits, and it's usually a limit, you're usually quoted a limit on your policy of whatever you end up buying of like 100, 300, or 25, 50, or 50, 100. And that just simply means that the liability coverage means that you are protected in it as a result of an accident for injuries that someone sustains for one person. Let's say it's a 50, 100,000 policy. for up to $50,000 for one person being injured, and up to $100,000 for everybody that gets injured. So if it's one person gets hurt, the maximum benefit is $50,000. Or if 3 people are hurt, 2 people, 3 people, 5 people, the maximum coverage is the $100,000. We are required as drivers in New York, owners of cars in New York, to have a thing called no fault. That's attached to every automobile policy. That means that no matter who's at fault, your medical expenses will be covered in case of injury. If you get injured by someone who's uninsured, then you are still covered for your basic economic loss that you sustain as a result of the accident. There are serious consequences for owning an automobile and not having it insured. You can lose your license. Actually, you don't even need to have an accident to have someone find out you don't have insurance, because you have to prove that you have insurance. And if you do not, on a vehicle, you need to turn the plates in on the vehicle and make sure that you can't just put the car aside saying, well, I'm not driving it. You have to turn the plates in on the vehicle and take it off the road when you don't have insurance. Because if you don't have insurance and you have this car that's licensed, registered in New York, you could actually have your license suspended for the number of days that you had that vehicle and that it was being operated without insurance. And that can be quite a steep price to pay. So we all are required to have that. Everyone is different. Again, the insurance is to protect you in the case of a loss. So you have to choose the automobile policy that works best for you. What are you protecting? You are protecting your financial situation as a result of having insurance. So that means that if you were involved in an accident and you hurt someone and that person sues you, you'll have coverage so that you don't have to pay out of your own pocket, lose your assets, lose your bank accounts because of that particular accident. So what someone needs to do is to figure out, how much insurance do I need? What do I have to protect? On top of that, you can get, as I mentioned before, you have no fault coverage, but you can get extended coverage, supplemental uninsured coverage, they call it some coverage, supplemental uninsured motor vehicle coverage. And what that means is that if someone hits you that is uninsured or underinsured, you can actually increase your policy so that you're not stuck with recovering just what was on their policy limits, because you may have sustained injuries that are worth more than that. You can actually get increases to your own policy that if you get injured by someone else who doesn't have the kind of coverage you have, that you can actually get coverage up to the amount of the maximum on your own policy. That's something that you need to consider. So it's how much you want to protect in case you get involved in an accident. Decide what it is that you have to protect. Do you have a family to protect? Is it just you? Is it how much property do you have that you have to protect? All these sorts of things go into your individual determination, and you need to decide that when you go out and find insurance. Auto insurance, home insurance, health insurance, all that stuff. The cheapest doesn't always mean that it's the best. It depends on your facts and circumstances. You don't want to be penny wise and pound foolish and say, well, I'm going to be able to save $10 a month if I get this other policy. Well, the other policy may not meet what your individual needs are. So it's really important that you understand what your needs are and then go out and decide what policy that you need to get. Another big insurance that we talk about is home insurance. There can be 2 types of home insurance. One is where you own your own home, so you have homeowner's insurance. And as a tenant, you can also get insurance. It wouldn't be to cover your home, but it would be to cover your things in an apartment that you live in. I recommend highly that people who are renting investigate getting renter's insurance. It really isn't that expensive. And what you do is you're protecting all of your personal property that you brought into the apartment. And you're getting yourself liability coverage, which means that if somebody is hurt because of your use of the apartment, that you would be protected as well. We hear all the times about renters who maybe had a fire in their apartment, lost their things. And they have to understand that although the landlord may have had coverage on the structure, the building, the apartment, that does not provide coverage to the contents owned by the tenant. So tenants should really, really look into getting coverage on their personal property. Some people would say, well, I don't have that much stuff. And you may not, but there are things that are valuable to us that we don't necessarily think about, where it might be our electronics, computers, televisions. They can be really expensive. It may be other personal effects that you have on the property. So it's something that people should consider. And again, it's really not that expensive to obtain those policies and provides a real high level of comfort for those who are renting. But homeowner insurance policies are for the homeowners covers the structure, so we think of a fire or some other things. In my case, when I had my frozen water pipe, it covered that. And it covers damage to the structure as a result of an unforeseen event, a contingency, some type of peril, rain, fire. It may include damage caused by infiltration by water and those sorts of things. You can get riders that protect against sewer backups and that sort of thing. There's all different types of protection. Again, we emphasize that people have to understand what is their need and what works out best for them. So it also covers, to some extent, with the policy, personal property located within the house, but you have to be very careful and talk to your insurance agent to find out what it actually covers. It may not cover that valuable piece of art. It may not cover that piece of jewelry. You need to check with your insurance provider, and if you do need coverage for that, diamond rings, valuable electronic devices, things like that, you may have to have that added to the policy for an additional small cost so that those are protected. So if something happens to them as a result of some type of peril, that it'll be covered. Typically, the peril is due to something that happens to the structure. And why I say that is if you get insurance for a television and your television goes on the fritz, it usually doesn't cover that. That's usually a warranty by the seller of the electronic device, the television and that sort of thing. It would cover if there was a fire and the television was destroyed. Or if, I don't know if it would cover this, but if somebody throws a bowling ball through the front window because they're playing out in the front yard and it breaks something in the house, then it may cover something like that. But again, you need to check those sorts of things. And then say, okay, I need that particular type of coverage. In my particular circumstance, I have coverage on my house, and then I have coverage for certain contents located within the house. The other good thing, and I'll point this out, it's kind of a segue, it doesn't deal with the insurance part of it, but I guess it kind of goes hand in hand with it, is I highly, highly recommend, especially in this day and age with video cameras and cameras on our cell phones and those sorts of things, is video everything in your home. If you have a theft or if you have a fire, by the nature of a theft, the items are gone. And so how do you prove to your insurance company what you had at any particular point in time? Same thing with a fire. It gets destroyed because the fire burned and it all burned to a crisp and you don't have anything. If you had a video going through open drawers, open closets, open cabinets, and just video everything. And do it periodically because things change. We buy more stuff. That's great proof to show, hey, this is what I lost. It also helps you too, because we always forget everything that we have. You know, we probably have so much stuff that we forget a lot of it. And we don't realize till after, oh yeah, where's that? Oh yeah, we lost that. This way, if you film everything and then keep that in a safe place, you'll be able to make an insurance claim easier when it comes to that. Another aspect of homeowners policy is liability coverage. And liability coverage is if somebody gets hurt on your property, through the use of your property, you will have coverage. Again, it depends on how much coverage you purchase, but it's there available. And again, it protects you in the case of somebody invited onto your property and they fall into a hole that you dug and you never told them about it, and they sue you. It protects you financially in case something like that happens. The other big thing that we always hear about now, over the last 2 years we've been hearing a lot about, is health insurance. Again, it helps us protect us for financial loss in case of a health problem, so that we don't have to pay out of pocket thousands of dollars for medical visits and procedures. We can have insurance. Now we have to have insurance now under the Affordable Care Act. We're required to have insurance, or we have to pay a penalty on our taxes if we don't have it. And there are all types of coverages that are available out there, and it really depends on what a person's needs may be. I would encourage all of you to check out the New York State Department of Health website. It's New York State of Health. The website is NY State of Health, one word, nystateofhealth.ny.gov. And that is the marketplace where people can acquire insurance. Some of us have insurance through our employers, but others that are self-employed or don't have insurance, they can go to the New York State of Health website and figure out what it is that they need. And there are things that you have to do. You don't just go on and say, okay, I'll just take this one. There's things that you want to take into consideration. First, one thing you want to consider is what health benefits will be necessary for you and your family in the upcoming year, because the policies go to year. Such things as prescription drugs, physical therapy. Do you see out-of-network providers? Is there mental or behavioral health that may be needed? Maternity care, childbirth care, inpatient or maybe outpatient surgeries. Some of the things that you may want to consider in deciding what type of coverage you have. Then you take into account the budget, and it's really individual decisions that have to be made, because if, for instance, you're healthy and maybe you have a limited budget, you may be able to consider a monthly plan that is a lower monthly payment, but maybe higher deductibles or higher co-payments, because you figure, well, I'm young, I'm healthy, I don't anticipate any medical issues coming up, and therefore I'm more willing to pay a higher copay when I go to visit a physician to offset the fact that I can pay a lower monthly payment. Or maybe you're going to have certain medical needs that you have to make sure that you have coverage for, and maybe in that case you have a little bit higher monthly premium and lower deductibles and lower copays. And then there are some people based on income that are entitled to a subsidy to offset the cost of their insurance. And as I understand it, that you need to sign up for your insurance through that New York State marketplace in order to obtain the subsidy. So make sure that you do that. Then you have to come down and compare what the plans are. Some of the things that you need to consider are the monthly premium, the deductible, or any co-payments, the prescription formulary, which means what are the list of drugs that this particular insurance policy will cover. And if you regularly take prescription medications and they're not on that formulary, then you're not covered for them, and you'd have to pay out of pocket. So you want to check and see what each different policy covers as far as what your medications are. Are there any limits to the policy, and what are they? And one of the most important things you really need to consider is whether the providers that you go to, your healthcare professionals that you go to, are participating in that particular plan. If they are not, it doesn't do you a lot of good, because then you would have to go to as an out-of-network provider, and then it would be more expensive to you if they're outside of your plan. The two things that you should check with first is check with the plan to see who their providers are, their participating providers. Usually it's listed online, or you can contact them and contact the insurance company and find out if they're a provider. Also, I would check with my provider themselves and say, okay, here's what I'm looking for. I'm looking to sign for XYZ insurance plan. Are you a participating provider in there, meaning that when I come to you, it's only going to be a $20 copay? And see if they confirm that. And if they confirm that, then you're in good shape. And then at the end of it, when you do sign up, again, you just go online and you could sign up for the policy. Keep documentation of everything. Make sure that you have all types of documentation so that you can go back and confirm what it is that you have. As far as health insurance goes, there are other aspects that people need to consider. For example, our older New Yorkers might be covered by Medicare. And so Medicare would be their insurance coverage. And there are salespeople out there that or there's ability for you to purchase supplementals to your Medicare plan. So you can purchase, in essence, add-ons that would cover you above and beyond what Medicare would cover. And to investigate those, depending on what works best for you and under your facts and circumstances. The one thing that I do want to point out is there are these things out there called Medicare Advantage plans. It's unfortunate that that term is used, I think, because Medicare Advantage plans are not Medicare. It takes you out of Medicare. It's a separate plan, separate from Medicare. Now, it may be appropriate for you given your circumstances, but don't believe that the Medicare Advantage plan is part of Medicare. It actually is separate from Medicare and pulls you out from it, and you would not have the benefits and coverages of Medicare. So before you were to sign up for a Medicare Advantage plan, make sure you investigate all options. I know that there are health insurance counselors in every county that can assist you with help, not making the decision for you, those of you that are on Medicare and choosing plans, but would be able to assist you in helping to explain what your options are. And then you could ultimately make the decision. The most important thing is we be good consumers. And being good consumers is investigating all the facts, investigating all the options, and then making an informed decision. And then when we make the informed decision, then we're much easier to live with it. If we just go willy-nilly and just make a decision and say, oh, eeny, meeny, miny, mo, I'll pick this insurance, and it proves that it's not best for us, that's kind of shame on us. We should know to do some investigation. That's it with as far as health insurance. There's other types of insurance out there. Like I said, there's all types of policies that can protect us for different things. There can be disability insurance in case we become disabled. It will pay us our lost income or a portion of our lost income for the period of time that we're on a disability. It's there designing to protect our income in case we have an event that causes us to be unable to work. Usually when we get a loan from someone, mortgage loan, auto loan, one of those things, we get offered a disability and life policy. And that is a group policy. And there's some special characteristics of it that we need to understand. One is, if you went out and just got a regular disability policy, it covers you for whatever the amount you have coverage for. income up to a certain amount a month or whatever. And you get that no matter what. So if you're disabled, unable to work, you will get paid that. With a group disability policy that you would get when you get a loan for a car or a loan for your house, you understand that it only covers the loan debt. So if you get that policy, it just means that if you become disabled, you don't have the income and you can't make the monthly car payment, this policy will kick in to make the car payment for you. Here's the downside. The downside is that if you get hurt in the last month that you own that policy, the only thing that policy you would have paid X number of dollars a month for the whole life of the car loan. Let's say it's a 5-year car loan. So you go 4 years and 11 months, you've made the payments, you become disabled, and even though you've paid all that premium money with your monthly auto payment, the only thing the insurance company does is pay that last month. That's it. Whereas if you went out and got a regular disability policy, and it is a little more expensive, that if whatever it is, let's say it's a $350 a month benefit or something. I'll just grab a number. That if you become disabled at 4 years, 11 months, then you not only get to use the money to pay that last monthly payment, but you then continue to get that benefit over the length of time that you are disabled. I'm not trying to advocate for one or the other. The important thing is that you understand that when you get that policy associated with the loan, that it only is going to cover that loan. And if the loan doesn't exist anymore, then you don't have any more coverage. Same with life insurance. There's life insurance group life insurance policies, which you can get a life insurance policy on a loan, a car, a house, or things like that. And what ends up happening is if someone should die during the term of the loan, the insurance policy only pays off that loan. It doesn't pay a lump sum. Whereas if you go out and get say you buy a $25,000 car, you get a loan for $25,000. So you get a group life insurance policy, and so you're paid each month as you're paying, and then partway through the loan, you pass away, the policy will only cover what's the remaining term amount of that loan. Whereas if you just went out and bought a $25,000 life insurance policy, what you would get is $25,000. And if there's only $5,000 left on the loan, you can take the $25,000, use the $5,000 to pay off the loan, and then you have $20,000 left over. Again, you have to choose what works out best for you in making those particular decisions and understand the difference. Another type of insurance is long-term care insurance. We're hearing more and more about that. The cost of long-term care is really, really expensive. I was just at a seminar last week and discovered that the average cost of nursing home care is approximately $10,000 a month. That's $120,000 a year. And I'm not going to get into this whole Medicaid planning discussion, protecting your assets in the case of going into a nursing home. But what you would have to do is get together with your financial advisors and attorneys to decide how you want to protect your assets and income in the case that you might have to go into a long-term care facility. There are different strategies that you can undertake to try and protect whatever assets that you have, and that could include the purchase of a long-term care insurance policy. And what that policy does is it pays, there are different types of them, but essentially it pays all or a portion of your long-term care in the event that you would need to have it. In case you go into a long-term care facility. It's really important to have an estate plan set up, especially if you have assets available, so that you can make the best decision for you. The last thing that I'll talk about is life insurance. Again, it protects in the case of loss of life. There's really two main aspects of life insurance, two different types of coverage in general categories, and the two are term coverage and whole life coverage. The term coverage is exactly what it means. Term. It covers you for a specific term, a year. So you have insurance that covers you for that year. And the premium you have to pay for that insurance is what it will cost you to have that coverage for that year. So it's this would be obvious, I think, but the younger you are, the less the premium is, because one of the factors in the premium is whether or not the policy is actually going to go into effect. In other words, have to be used, cashed in during that period of time, and it's less likely that you're going to have to cash that policy in as a 25-year-old than if you are 85 years old. So the policy premium that you pay is based on how much exposure the insurance company has for that particular time period. So if you're 25 years old, the exposure for the insurance company is significantly less than the exposure if you were 85. So the premium's a lot less. And so as you age, you hit milestones of 40 and 50 and 55, the premiums on term insurance markedly will go up. There's another, the other type is whole life policy, and that is the flat premium, meaning if you get this policy when you're 20 years old, and you'll keep it for however long that you're alive, obviously they can spread the insurance company can spread the exposure over a long, long period of time. And so your premium will be level throughout all of that term. And so you may be able to get $100,000 worth of coverage. You say, well, I'll keep that for my entire life. Well, I'll get it as a 25-year-old where it's a lot less expensive, and then it continues to go on. Whereas if you bought term insurance, you can get, yes, $100,000 at 25 years old is very inexpensive. But by the time you get into your 50s and 60s, it gets really expensive. And the premium goes up over that period of time. You have to choose what will work best for you. Now, the whole life premium, the whole life policies were the ones that were used and sold as the vanishing premium life insurance policies. Because what they said was, and that I mentioned at the outset, what that was is that they were sold by saying, well, look, if you buy this whole life policy as a 25-year-old and pay X number of dollars a year for 10 years, then you, in essence, will have a fully paid up $100,000 policy that you would then not have to pay premiums on it anymore. And people were saying, oh, wow, that's a great thing. Well, I bought those when I was younger. I have a couple of them. And I'm still paying the premiums now, 30 years later. The premium never disappeared. But I understood that when I bought it. I knew the deal. I knew what was going on. But what has happened is the value of the policy has increased. Because I haven't stopped paying the premium, I just continued to pay the premium. I don't even think about it. I just pay it, and I don't think about it now because I thought about it when I bought it. But I can't tell you, but if I bought a $100,000 policy, it might be worth $200,000 now because I paid over the whole life. And the cash value of the policy is a lot greater. But I didn't buy it saying that, this premium is going to vanish. You have to understand how it works. What insurance companies do is they take our premiums, they invest the money and make it grow. And then they make money off that. And then hopefully people won't make claims against the policy so that they have that much more money. But people do make claims. People, as far as life insurance goes, people die and policies have to be paid. And what the hope is that based on actuarial studies over the whole life, over the whole population of all the customers that come in and they pay their premiums, that more are going to be paid in premiums than are going to be paid out in benefits. That's the whole. More money will come in premiums, and more money will come in investing those premiums by the insurance company than what will be paid out, and then the insurance company makes, and its shareholders will make money. So the way that these come down is term policies are cheaper when they're younger. Whole life policies, even if you get it at younger, is a little bit more expensive than a term policy. But here's what happens. The term policy is here. The whole life policy is here. As the whole life policy, as we talked, the premium goes like this as you get year to year to year. But that's the whole life. The term policy premium goes like this. So you may pay, actually it goes like this. It's lower initially, but then it'll eventually get higher to where you end up paying more. So the thing is we fall back to being a good consumer. What do we need? For how long do we need it? If we have a family and we have to provide for our children, what should happen if something should happen to me, whether it's a disability or it's a death? How can my family be provided for? That's what someone should consider in deciding what type of life insurance policy that they should have, and then make the decisions accordingly. Then maybe as you get older, the kids are all gone, maybe you need less insurance, so you can cut back on it somewhat. It depends on your facts and circumstances. As you can see, there are many different products that cover many different risks that are out there. Home, life, disability, auto, long-term care. There's all kinds of insurance that can cover us out there. We need to be good consumers, and that comes into play in purchasing these things. First, determine what you need. Don't have somebody tell you what you need. Don't have somebody convince you that this is what you need. You can have somebody explain to you what you might need. Look, you need to protect this much in income, or you need to protect this much so that you can support your family on into the future, and then make the decision accordingly. Decide what product is best to meet your own individual needs. Shop around and find the best company. Just because they advertise with splashy ads on television doesn't mean it's the insurance company for you. Make your decisions based on what type of coverage and on the quality of the policy. Each decision is unique. What is good for one is not necessarily good for other. Make sure that you choose based on what is right for you. Don't be rushed into purchasing something right away. If you feel pressure into being sold something, go somewhere else if you're uncomfortable with that. If you have a problem or a concern, you can file a complaint with the New York State Insurance Department, which licenses all insurance companies offering policies and coverage in New York. They are the overseer. Well, it's now the New York State Department of Financial Services, the insurance division. A couple of years back, the New York State Insurance Department and the New York State Banking Department combined together into an entity called the New York State Department of Financial Services. And they each have there's an insurance branch and there's a banking branch. So you can go to the insurance branch through the Department of Financial Services, or you can file a complaint with my office, which is the New York State Attorney General's office. We actually have, as far as the health insurance goes, we actually have a healthcare bureau, and the healthcare bureau lots of times will resolve issues related to something not being paid for health insurance, not being covered, or something. Can help mediate between the insurance company and the medical provider, so you may want to consider that. There's also assistance here locally through your Office for the Aging, so you may want to talk to them. They can also give you guidance as to who the HICAP coordinators are for the county. They can give you some guidance as to going through the insurance morass and deciding what might work best for you. We hope through this session that you've been able to get a little bit of a thumbnail sketch of the different insurances and the ways to be a good consumer associated with that. If you have any questions, again, contact New York State Attorney General's office. We'd be glad to try and give you some guidance or direct you to the right person. I'm sure that there's also help here down at Cornell Cooperative Extension where they can give you some guidance and direct you in the right way. Thank you for attending today. I hope you will come and join us sometime when we're down here at Cornell Cooperative Extension in our monthly Consumer Issues program. And I will turn it back to Kenneth.
Thank you very much, Mike. We appreciate this. It's been a very informative session. Right now, Mike's going to be available for any questions. So if we have any questions from the audience members, we'll go ahead and take those now.
Thank you.